I think the question is, why is oil about 1% lower across the board? I think the general consensus was that after these strikes, we'd see a spike in oil prices. Oil already up probably about $10 a barrel above its low, but pulling back.
And that's what we said in our note that we put out yesterday as well. We did think prices would pull back because this was so well telegraphed. I think the market had already priced in that there would be an escalation. There was going to be an Iranian reaction. Now, that doesn't mean that prices will continue to go down. I think this is very much that you always see this recently anyways with geopolitical events. People tend to take profits. The next step is going to be to see how Israel reacts. And depending on that, A, the market's going to remain choppy, but B, we could go back up again. Depending on the scale of that. We do think there are signs that it will not necessarily be escalatory. If that's the case, then we'll remain pretty range bound. But of course, the risks haven't gone away. But I completely expected prices to be lower today.
A bit of buy on the rumor, sell on the news. We saw the news happen, and then we see the sell-off. Going forward, how big of an impact are U.S. cuts going to have on the oil market? I mean, we had, at the beginning of the year, thought of 7 cuts. Now there's a possibility, if you listen to Neil Kashkari, we might not see any cuts. How much of that is also weighing on this market?
Yeah, I think that this is the big, for me, the most interesting dynamic that's going on right now. If you look at the physical crude market, it's actually very strong. It has been very strong. Prices are finally catching up to it. The $10 move, yes, is a little bit of geopolitics, but ultimately it's physical fundamentals. At the same time, I hear from the macro traders that, the global economy is the prospects are looking better because the Fed's going to start cutting interest rates. And I'm thinking, what if oil continues to go higher? Doesn't that derail what the Fed is doing? And we've got, a Medley Advisors who do our macro analysis, and we've done a lot of joint pieces kind of highlighting the risk that's the biggest risk for the Fed, that if you have energy prices shooting higher this summer, and yeah, I think that remains a real risk. I wouldn't say that's our base case, because what we are seeing in the market, like with US production underperforming, Mexico, Guyana, that's just generally underperformance on the supply side. OPEC is not going to add barrels at $90 oil. That is what could really throw the Fed strategy.
I've seen some speculation about whether we're actually going to see oil prices hitting that $100 barrel mark once again. And of course, you were just suggesting there that this could also have implications for inflation and obviously monetary policy. What is the likelihood that we're actually going to see prices escalating that far?
Look, with oil prices, we always tend to overshoot and undershoot, right? Like, I think OPEC have done a marvelous job in keeping it pretty tight. If you look at the range, last year was pretty range bound, even this year, still $80 to $90. But generally, especially when you don't have a lot of inventories, and that's the main point I would want to stress on, we are low on stocks pretty much everywhere. And if that happens, then if you get geopolitical tensions like this, you could. It doesn't mean that we'll sustain above $100, but I won't sit here and say, we'll never, we'll stop at $99.99. It's never that perfect. And again, that's where I do think there are risks around calling for 3 Fed cuts, for instance, because we just don't know what that summer of energy prices could look like.